Portfolio equals identity or tool. A behavioral finance perspective. Is your portfolio an extension of who you are? Or is it simply a financial instrument designed to serve your goals? How you answer this question has serious psychological and performance consequences. Let's examine the research. 1. When a portfolio becomes identity. In psychology, identity refers to the traits, roles, and narratives people use to define themselves. If someone says, "I'm a growth investor," "I'm a crypto person," "I'm a value purist," "I'm a market contrarian," the portfolio is no longer just allocation. It becomes self-definition. According to social psychologist Leon Festinger and his theory of cognitive dissonance, when identity is attached to beliefs or behaviors, contradictory evidence becomes psychologically threatening. If your portfolio equals your personality, losses feel personal. Changing strategy feels like self-betrayal. Admitting mistakes feels like weakness. Identity amplifies emotion. 2. Ego involvement and loss aversion. Behavioral economists Daniel Kahneman and Amos Tversky demonstrated that losses hurt roughly twice as much as gains feel good. Now imagine those losses are not just financial, but identity-based. If your portfolio is your personality, a drawdown challenges your intelligence. Underperformance challenges your competence. Volatility challenges your confidence. The emotional intensity increases. This raises the probability of panic selling, doubling down to prove you're right, refusing to update beliefs. 3. The tool framework, a different mental model. Contrast that with a portfolio as tool mindset. A hammer is not your identity. A spreadsheet is not your personality. A portfolio is not your self-worth. It is a mechanism designed to allocate capital, manage risk, capture long-term growth. In this framework, losses are data. Volatility is expected variance. Strategy adjustments are optimization, not self-criticism. Emotion decreases. Clarity increases. 4. Overconfidence and the identity trap. Research by Barber and Odeen shows that higher trading frequency correlates with lower average returns. One driver is overconfidence. When the portfolio is identity, you feel pressure to have opinions. You feel pressure to act. You feel pressure to outperform. Action reinforces identity. But action increases costs and mistakes. When the portfolio is a tool, action is optional. Inaction can be strategic. Ego has less influence. 5. Social comparison intensifies identity. Social comparison theory suggests we evaluate ourselves relative to others. If portfolio equals personality, other people's gains feel threatening. Underperformance feels humiliating. Outperformance feels validating. Your emotional state becomes market dependent. But if portfolio equals tool, others' results are information, not judgment. Your focus stays on your plan. External comparison loses emotional power. 6. Identity narrows flexibility. Identity is sticky. If you identify as a tech investor, a dividend purist, an aggressive risk taker, adapting becomes difficult. You may ignore changing macro conditions, risk misalignment, new evidence. As argued by Burton Malkiel in A Random Walk Down Wall Street, markets contain strong elements of randomness. Overconfidence and style consistency often misleads investors. Tools evolve. Identities resist change. 7. Emotional diversification versus concentrated self-worth. Financial diversification reduces risk. Psychological diversification does the same. If your identity is diversified across career, relationships, health, skills, interests, market fluctuations do not destabilize your self-concept. But if investor becomes dominant, portfolio volatility becomes emotional volatility. This increases stress and impulsive behavior. 8. Long-term discipline requires psychological distance. Successful long-term investing depends more on behavior than intelligence. Behavior improves when ego is minimized. Outcomes are depersonalized. Decisions follow process. A tool-based mindset creates distance. I use this portfolio to pursue goals. An identity-based mindset creates fusion. This portfolio represents me. Distance supports discipline. Fusion amplifies emotion. 9. The performance consequences. When portfolio equals personality, confirmation bias increases. Loss aversion intensifies. Action bias rises. Strategy switching becomes emotional. Social comparison dominates. When portfolio equals tool, process orientation improves. Volatility tolerance increases. Adaptation becomes easier. Emotional regulation strengthens. The same assets. Different psychology. Different outcomes. Conclusion. A portfolio can be a mirror or a machine. If it is a mirror, every fluctuation reflects on you. If it is a machine, it simply performs a function. The research suggests the less your identity is tied to your portfolio, the more rational and resilient your investment behavior becomes. Wealth building works best when your portfolio is a tool, not your personality.